The changes that have been announced to capital gains taxes have some Canadians wondering if they should give or sell properties to their adult children now to avoid higher taxes in the future. They may also be thinking about selling some of those assets to their kids at a discount. They believe that this will give them two benefits. Number one, that they will give their child a deal on a property, and number two, that they can lower their own tax bill. In this video, I'm going to talk about the risks of selling assets to your kids at a discount, specifically the potential for double taxation. I will begin with introducing a hypothetical situation, then I'll talk about how double taxation occurs, then I'll give you three alternatives that may make the transfer of that asset to your children more smooth and tax efficient. And if we haven't met yet, my name is Mark Walhout, and I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. So we'll start by introducing our hypothetical family. Jill Hill owns a cottage that she purchased for $100,000 that has appreciated in value and is now worth $400,000. Jill has thought about selling the cottage for years, but her son John has indicated that he may be interested in purchasing the property from his mother Jill. John recently purchased his first home, so he isn't in a great financial position to make another real estate purchase at the moment. Jill decides that she wants to help Josh purchase the property by selling it to him at a discount. Jill's rationale is that A, she can help out her son by giving him a deal on the property, and B, she can lower her own tax bill today by taking a lower price on the sale of the cottage. So everybody wins, right? Not so fast, says the CRA. When property is sold to a non-arm's length person, like a transaction between a parent and a child, and the sale price is less than the property's fair market value, the CRA deems that the deemed sale price of the asset is actually the fair market value, and taxes will need to be paid by the seller accordingly. The deemed purchase price for the asset is the actual price paid for the asset. And I'm going to get into this in a bit more detail in Jill and John's example as we move through the video. So why does the CRA do this? Well, they've kind of established that two people who are dealing at arm's length are assumed to be operating in their own best interests and arriving at a fair and reasonable price for an asset. For example, for her cottage, Jill would not give the low price of $200,000 to anyone else other than her son. She's trying to do her son a favor. By selling to her son John at a lower price, she's avoiding taxes that would otherwise be payable had she sold the cottage at fair market value. If Jill and John go ahead with the transaction as outlined, this can result in additional taxes and penalties for Jill if she's audited, and it can mean double taxation on the capital gains on the cottage when John eventually sells or passes the cottage down. So now let's go through the details of how taxes will work in John and Jill's situation. So we'll start with what Jill and John intended to happen when they entered into this transaction. So remember that Jill bought the cottage some years ago for $100,000. She plans to sell it to her son John for $200,000. On her taxes, she would plan to report a capital gain of $100,000. Since the gain is below the $250,000 threshold in 2024, only 50% of the gain is included in income, or $50,000. Assuming that her average tax rate is 30%, that means there will be $15,000 of taxes payable due to the sale of the cottage on Jill's tax return. John's adjusted cost base for the cottage is going to be $200,000, the price that he paid for the cottage. Next year, John changes his mind and decides to sell the cottage to an arm's length person for $400,000. On his taxes, he plans to report a capital gain of $200,000. Since the gain is below the $250,000 threshold, only 50% of the gain is included in income, or $100,000. Assuming John's average tax rate is also 30%, that means $30,000 of taxes on John's cottage sale will be owed in the year that he completes the transaction. So the total amount of taxes paid between Jill and John over the two transactions as reported is $45,000. But here's what actually happens if the CRA decides to audit Jill on the sale of the cottage to John. She is deemed to have disposed of the cottage at fair market value of $400,000. And note that it doesn't matter that she sold the cottage to John for $200,000. The CRA says, nope, you are dealing with John, who is a non-arm's length person, and it's deemed that the sale price for that cottage has to be its fair market value at the time of the sale, which was $400,000. Her tax return is adjusted to reflect a $300,000 capital gain in 2024. Assuming that she completes the transaction after the June 25th, 2024 deadline, that the budget has indicated that the new capital gains tax changes will come effect as of, her 50% of the first $250,000 of that capital gain is included in income. 66.67 of the next 50,000 of the capital gain is also included in income. So a total of $158,335 is included in income in the year of sale for the cottage. Assuming a 30% average tax rate for Jill, that means that taxes will be $47,550 on Jill's cottage sale. Even though Jill's tax bill was reassessed as though she sold the cottage at fair market value, John's adjusted cost base remains what he paid for the cottage, $200,000. The amount of the gain between John's purchase price and the fair market value, therefore, is taxed twice, once with Jill and then again when John goes to sell the property. So if John continues along and sells the cottage next year, he reports his capital gain the exact same way. On his taxes, he plans to report a capital gain of $200,000. Since the gain is below the $250,000 threshold, only 50% of that gain is included in income, or $100,000. Assuming that John's average tax rate is still 30%, that means that $30,000 of taxes on John's cottage sale will be payable in the year that he sells the cottage. The total tax paid between the two transactions will be $77,500.50 versus the $45,000 that they had originally planned out when they entered into this transaction. So what are some alternatives for Jill and John? They still want to enter into this transaction, but they want to avoid double tax and they want to avoid issues with the CRA. To me, there are three alternatives that Jill and John can explore. Alternative number one, if Jill really wants to sell the cottage to John, but John doesn't have the money to pay her back right now, she can work with her lawyer and accountant to draft a purchase agreement with John at the fair market value of $400,000 and take back what's called a promissory note, which is a fancy word for a loan agreement that says that John will pay her back within the next several years. This strategy helps Jill and John avoid double taxation, and it allows Jill to use something called a capital gains reserve. The capital gains reserve is designed to allow a seller to realize their capital gain over up to 5 years if the payment for the asset is received over a longer period of time. I won't go into the details of the capital gains reserve in this video, but I'll include some links below if you want to learn more. Alternative number two is that Jill can simply give the cottage to John for $0. Jill can work with a lawyer to establish that the gift is being given with no expectation of repayment at the current market value of $400,000 so that it's recorded that we've established fair market value, that taxes are filed properly, and the gift is actually a gift to John. There's no expectation of repayment. The downside to this, of course, is that she would receive no proceeds for the sale of the cottage, and she'd need to have money set aside to pay the tax bill on the capital gain. John's adjusted cost base for the cottage, if he were to go ahead and sell it down the road, would be $400,000. So if the property did not change in value between now and when John sells the property next year, he'd have zero capital gain and there would be no double tax scenario. The third alternative is that Jill can simply keep the cottage and let John use it. Remember that from the beginning of the video, Jill was simply considering selling the cottage. There's no real financial motivation for Jill to part with the asset, and John loves the cottage and wants to have access to it. There's nothing that says that Jill can't simply hold on to the cottage and allow John to use it for some number of years, and then maybe sell it to John at fair market value, or give it to John down the road and avoid the double taxation scenario that we've outlined in this video. There's no real urgency for Jill to transfer this asset. Why go through the hassle, the risk, and the early payment of taxes if she doesn't need to, even if it will result in her paying taxes at a higher rate down the road? In closing, if you're considering selling or transferring a property to an adult child, please work closely with your financial planner, your accountant, and your lawyer to ensure that the transfer is done correctly. You don't want a nasty tax surprise of double taxation, interest, and penalties to ruin what is meant to be a nice thing, the smooth transition of a beloved asset to the next generation. Thanks for watching this video all the way to the end. If you like it, give it a thumbs up. Leave your questions and comments below. I'll also direct your attention to a few resources that are in the comments. First resource is my newsletter, which is called the Retirement Roundup, where I include a short video and a number of articles that I read during the week that I think are helpful to retirees. It spans topics including investment topics, financial planning topics, and retirement lifestyle topics. I've also included a link to my retirement mailbag survey. It's a 2-question survey. If you have a question that you want me to address on an upcoming mailbag episode, it takes about maybe 30 seconds to include a question in that survey. So I encourage you to check that out. Number 3, I'll include links that I've discussed in today's episode. So today we talked a little bit about the capital gains reserve. I'll include some information on that below. I've also included my retirement monthly spending planner, which is a simple spreadsheet that will help you plan out your expenses in retirement. A lot of people have downloaded it and remarked that they really find it to be valuable. So hopefully you check it out and you enjoy it. And I hope that you find it helpful for you as well. Thanks for watching this video all the way to the end, and I'll speak with you soon. Take care.